It's Tuesday. How you doing, Chris?
I am.
It must be Tuesday because
good.
I'm on a podcast with Chris Franks.
I mean,
Oh,
we're
I should
looking
actually,
good.
I should call you Christopher because that you've changed your name on LinkedIn to Christopher over Chris. I noticed.
I have. Do you know why, Anthony?
You like Winnie the Pooh?
Outreach. If I know they put in "Hi, Christopher," I know they don't know why.
Smart.
Yeah.
That's smart. That's really
it's
smart.
just a little hack too.
Speaking of names, I've been thinking about names quite a bit. So one of the things, I have a buddy named Lance, and Lance is a rare name nowadays, but in medieval times, people used to be called Lance a lot.
Anthony, I have maybe my worst joke ever.
Okay.
It is stock show season here in Denver, and a little bit of cowboy joke going. Hey, where do you find a horse with no legs, Anthony? Right where you left it.
Well, I missed it. I was thinking. You didn't let me think. But what did you say? I didn't miss the punchline.
Right where you left it.
Okay, I'm glad I missed the punchline the first time. I should have just left it alone.
I, for one, think that is a great joke.
That is not true because you said you qualified it with the worst dad joke you've ever told.
Worst equaling best. It's a dad joke, Anthony. If people don't kind of roll their eyes a little bit, it's not a good dad joke. All right, Anthony, what would you change if you manage money like your restaurant owner neighbor? Stefan Wynn ran to Marin's Kitchen. Stephanie. Oh, Stephanie. In Portland for 11 years on cash reserves that rarely exceeded 2 weeks. When she finally sold to open a tech startup, her investors were baffled by her obsessive daily cash tracking. Today on How to Founder, we're going to talk about founder financial literacy. I am your host, Chris Franks. With me, Mr. Anthony Franco. We have Heidi Knoblauch from upstate New York, and Heidi's big time. She's got a plow guy.
That's true. Love my plow guy.
Yeah, I mean, just saying, pretty big time if you have a plow guy. Heidi Knoblauch built Plum Oyster Bar, managed $180 million in venture funds, founded a failed hospitality startup, and now runs Home Field Fund, helping founders develop the financial instincts that they need to be successful and helping funders start funds. Welcome, Heidi. It is good to meet you. It's fun that you have a plow guy. This is a great topic. It's not one that we've really covered that much in the show, which is, what do I need to do? I'm starting to go raise money. I've got this little startup. I've got some stuff. Maybe I've got an MVP, maybe even have a little bit of revenue. But this trying to get myself organized and ready to go raise money is an entirely different thing. Just get me started. I come to you and just be like, hey, what do I need to be thinking about even early in structuring my financials in a way that's going to make me be able to go raise money?
Yeah, absolutely. So I would say that if you had me on screen with those dad jokes, I was laughing behind the scenes. So I feel like that was a seriously missed opportunity right there.
No, Heidi, it's a risk reward analysis that we've done. We've calculated this. Most of the time, our guests do not appreciate the dad jokes, so we've taken them off in order to not let that come through to our audience. But do appreciate.
Yeah, we've even lost a couple guests. They hear our dad jokes. So it's like, it's high risk.
Yeah, absolutely. So I think I'll just start. I think many of you know that a lot of communities have resources for entrepreneurs. So typically those kind of either come from government or they come from a university and they look like an entrepreneur in residence, right? And those types of resources I find are really, or like a I-Corps, for instance. And those types of resources are pretty good at getting a founder to understand like its market, getting a founder to understand its TAM, SAM, SUM, for instance. But what I did after closing Plum Oyster Bar, because I had gotten in the startup community through that SaaS company that you mentioned, is I created just Plumline Consulting. Just moved off, kind of kept the Plum name, but did Plumline Consulting. And through that, I was running a venture readiness program, which is essentially a bolt-on for these other entrepreneurship programs that founders can get. So we do 3 things. It's very concrete, very clear. The 3 things we do are help someone create a data room. And what I want to focus, I think, on this podcast is, what does that mean? What is a data room? The second is that we help people understand just like basic, what I would call investor hygiene. So making sure that you're updating people who could be investors. And the third is creating a fundraising plan. So I think, and I'll launch into it, Chris, but I just want you to interrupt me kind of as I'm going through, because we don't want this podcast. We want more dad jokes. We want dad jokes as we're going.
Well, I mean, the plum thing, the plum
Every
thing,
single
Chris,
pitch deck ends up with 100 million in revenue by year 3. Like it's just.
it's
like,
yeah, it's one. They all from the bottom left to the top right.
It goes like that.
But I do have another plum dad joke. What did the professor say when he put his hands in his pockets? Plums? I don't remember buying plums. No.
What?
All right, let's move on.
Anthony, first of all, I teach. I'm a distinguished professor. First of all, I teach in a business school, and I have no idea what you're talking about. But I love that. That might be the
Chris.
best dad joke we've got.
Yeah, I don't even. Yeah. All right, let's just move on there.
Okay. We'll cut that out, but it's live. But we'll cut it out.
But it's live. So I think that the first thing, and I want you to go into the data room, and I think it's a really important point. It's like, what do you track over time? But even before that, as I'm preparing, and this is a question that, Anthony, I get fairly frequently. Most founders have 3 sets of financials. They have the one that they think is actually right. They're still optimistic. They have a worst case, like, oh crap, set of financials. How do I keep this thing alive? And then they have the one they show their investors, right? Which is always this wildly optimistic, oh, if we just sell 1 cup of tea to every person on the continent of Asia, we'll be fine, right? So first of all, what should I be thinking about as I'm trying to build a set of financials that I plan on showing investors?
Yeah, and I guess what I would say is that I think every company should have a data room that allows them to get money in some way, right? So if you think about you ever bought a house, anything like that, it's obviously easier when you're buying something like real estate if you have all your ducks in a row. Let's say it's even an investment property, you got your pro forma, things like that. That's much easier, I think, if you have everything in a row. So even if you have founders who aren't going to raise money from an investor, who are thinking about going the debt route, they should absolutely still have a data room. And I'll just describe some of the boring stuff that's in there and then some of the more exciting stuff that's in there. So first of all, this data room should live on some share drive. I don't care if it's Dropbox, Box, or if it's Google Drive, it should live somewhere that you can easily share it. And the boring stuff that's in there is like stuff that founders like typically just would have to find if they met an investor. So like your articles of incorporation, right? Your operating agreement. Those sorts of things should be just clearly in a data room in a folder that says either like legal documents or whatever the case may be, organized. But the more dynamic stuff, I think, and this is what the Venture Readiness program does, is it works with founders on the more, like you said, Chris, like the stuff that, okay, you could have these 3 different presentations of something, but really you want to have one presentation of it. And so the first is like, what's your market, right? What's the TAM, SAM, SUM in your market? Does that live on one slide in a pitch deck that you have in your data room? Probably. But do you need to explain it a little bit more? Maybe, right? Just a 5-year projection. I think a lot of people do these 3-year projections. It's probably not enough time, right? I would argue that you have to get, obviously, if you're raising venture capital, you have to get to a pretty significant market size very quickly, right? Because that's who's going to invest in you. They're going to invest in the rapid growth. And to be honest, that's why you would give up such a significant part of your company is in exchange for that fuel that would give you the rapid growth. It's not necessarily to sustain some like kind of cash flow thing, right? It's truly for growth. But if you're raising debt, it's the same thing. You want to have projections that you can show a bank, that you can show an SBA 7A, provider that will help you get funding, right? And those 2 look very different, but they should both, if you're, depending on which one you're going after, they should live in the data room.
Anthony, I've had both, right? When we were coming up, we used to be a binder. Like we'd have the founder folder that you'd have all that stuff in. And then last company, I was like, oh, I'm never selling this. I don't like, why do I have to worry about putting my monthly financials into it? Like it's a services company. I'm just doing this for a paycheck.
And then you sold it.
Yeah. Then when somebody wanted to buy it, I was like, oh crap.
That's right.
And I had to spend
That's right.
hours going back into QuickBooks and pulling monthly statements, things like that. Anthony, how about you? Have you been pretty disciplined about this stuff, or are you kind of all over the place?
Chris, you know me. How disciplined do you think I was with doing this? No, financial discipline is not, it does not serve the builder mentality. It is a necessary evil.
Mm-hmm.
And so I do it begrudgingly. Therefore, it's not. It often. I've been in the same situation as you, Chris, where it's like, oh, I got to go back as I'm going to show this to investors, and I've got to go make this. I've got to go do all the work that I should have been doing all along to get it ready for investors. So,
does anybody have our login to DocuSign?
QuickBooks. Who owns QuickBooks right now? I forget.
and I think what I would say, right? It's exactly, Anthony. It's exactly what you said. Like this is the annoying stuff that if you just do it over time and have that kind of discipline with it, but the next thing I want to talk to you about, well, I'm going to talk about the two other facets of venture readiness, but then what I want to turn to is who are you even asking for money?
Okay, so
like
just
who
to wrap
has
up
money?
This conversation.
Yeah.
Data room's got to hold a bunch of important documents. Do that on a regular basis so that when you're ready to raise funds, it's really easy. But also, to your point, Heidi, this is about running a good company. Mm-hmm. And good companies are disciplined about putting and organizing their financials. So even if you're not immediately going out to raise funds, this is about being a good operator. Being a good operator means you should do this. Okay, perfect. What's our second point, Heidi?
So I will say with the two other things we do with venture readiness, which is, that fundraising plan and also just investor hygiene. I'll talk about investor hygiene first. Like, what does that mean? The moment that you are thinking about starting a company, and I don't care exactly how you organize this information. It could be a Google spreadsheet, or it could be MailChimp, or however you want to organize this. You should have some mechanism by letting people know that you're starting the company and progress on the company, because you never know in your network who could potentially invest in the company. And they're much more likely to invest if they've kind of seen how you've grown, if they've seen the progress over time. So you could imagine sending out an email saying, we've got 100 beta users. That might start to kind of drive that momentum, right? It's kind of like when you're networking. One of the piece of advice that I tell people is like you have to be like genuinely interested in what people are saying rather than go to them in a transaction way. It's the same thing with investing. And now we have all of these tools that can keep people engaged over time with your company, and you can update them pretty easily with something like a mail list. And so what I would encourage founders to do, and Chris, you can frame the takeaway on this, but it's updating people who may be investors, who might not be investors, who you're not asking for money from immediately. It's updating them on the progress of your company. You want your friends and family to be in there. You want the person who you met on a networking event to kind of know about your company, and doing that very systematically will lay the foundation for a good fundraise.
So I think
I want to push back on one thing Heidi said. She said the moment you start thinking about a company, you need to get it organized into a folder structure and all of that. That would mean that all I am doing is organizing things for companies that I'm thinking about. Like I would never get anything done.
Anthony, I want to challenge you on one thing. How long does it take you to drag a PDF into a folder?
But I have to. You're saying I have to create the PDF? Like I'm thinking about creating companies like every single minute of every day. I couldn't do that.
Well, maybe. Well, if that's fair, I guess
to do that. That keeps me moving.
I guess yes. If you consider that anytime you think of an idea that's creating a company, then yes, I would say don't do that. Yeah.
Because he literally does. Like, wait, Anthony and I will go out and just, just be talking about life. And by the 15 minutes in, we started 3 companies.
Yeah, exactly right.
It just, it's an epidemic. All right.
You know what we should do? You know what we should do? That's that
You
pops
should
up
do.
like.
Right.
I'll tell you, Anthony, I'll tell you my latest one of those.
Oh yeah.
So I said to my wife, I was like, you know what I'm going to do? I'm going to create a windshield wiper fluid company that where the bottle is the exact amount that will fit into the
For the
car
love of
because
God, please start that company.
I hate that there's always a little bit left that then I got to cart around in my car.
Or replacement windshield wiper like containers for cars that actually.
I know.
Like,
That's right.
what are we doing, people?
You're right. And so, Anthony, to your point, I have not created a folder structure for that
If
company.
you don't start that company,
It is taking
I'm gonna be-
everything I have right now, Heidi, to tell you why that's a terrible idea. You're folding a map incorrectly in front of me. I'm literally having
Yeah.
a conniption fit over it.
Yeah.
All right.
It's gonna be called, the company's gonna be called To the Brim.
I so desperately want to derail this entire podcast and just now talk about this
But
company.
to Anthony's point, though, that's exactly right. No, should I invest any time in that company? Of course not. Is it something I say over dinner? Of course. Anthony, I'm sure you have some of those too. I would not recommend that you spend your time organizing
bad
those
ideas than
companies.
good ideas. Yeah, way
There you
more.
go. There you go.
So
All right,
back
data
to
room,
the
data room,
concept
Chris.
of continuing to keep a group of stakeholders engaged and involved. 2 questions. Number 1 is who?
Mhm.
I've got hundreds of people in my personal Gmail, email list that I could send out. I don't even know who half of them are anymore. Do I send it to everybody? And second of all, what is the right information and depth of information to start to provide? Because I'm just keeping people engaged at this point. I'm not sending out financials or financial performance, right?
Correct. So what I would say is definitely don't send it to everyone in your personal Gmail. Like anything in a startup, you want to see what works. So I would pick, 20 people, 50 people who are close to you, right? So like, for example, I work with a lot of students who want to start companies. So like I should be on their mailing list if we've worked together and started a company. So should everyone else in their classroom should be on their mailing list, right? But it's people who have known about your company is who you want to add that to. If you want to go, I think it's right, Chris, to go out and engage people about your company, but that's when you want to put them on the mailing list. Like they should know that it's coming. It shouldn't be an announcement about your company.
This is a really important piece because I do think this has changed a little bit in our time of being founders, Anthony, is that you used to never send out a cold email to a VC unless you absolutely had to. Absolute last resort, send a cold email. You wanted to get a warm introduction, particularly from another founder. Heidi, is that still hold true?
Yeah, and so I think I'm going to challenge you, Chris. You didn't listen to me.
Please, challenge me.
So you didn't listen to me, which is fine. But it's that if you're in a group networking setting and you meet a VC, you just basically want to say like, I'd love to keep you updated about my company. Can I add you to my mailing list? You absolutely do not want to go to PitchBook, download all of the VCs who have ever invested in that area and send them updates. The updates is for people who you've engaged with about your company.
So I think it's a really great point. So you're trying to keep people engaged.
Mm-hmm.
Back to the question: to what degree of information, what depth of information am I providing?
Good question. So there are, and I'm happy to provide this for your listeners, but there are lots of examples of people who do this really well. So I invested in 2 companies last year, and both of them do really good monthly updates, and they were doing those monthly updates before I invested actually. And so the monthly updates essentially say like, this is what we said we were going to do. This is what we accomplished. And, this is where the company is at now, and just any other updates. And oftentimes it ends with an ask, like, could you introduce me to this person or this person or this person? But it's, again, it's kind of it's an email not to thousands of people. It's an email to people who've engaged with your company that kind of keeps them engaged.
Anthony, the other piece here that I think is important is this group of people can smell bullshit, right? And so if you're just like, everything is so great, it's the greatest thing ever. We're crushing. We're destroying life. It's amazing. How do you personally, if they handle like rough news? I mean, are you completely honest? Or are you?
Oh, I'm good at this. Yeah. So this is my specialty. I have so many bad updates that I've gotten really good at this.
You're really good at spinning it. Like, yeah.
No, transparent. Look, you're right, Chris. It's not that they smell BS. It's just that they most people that are investing in companies have been where you're at, and there is no way they believe that you're not struggling in some area or another. First of all, you tell them because it's true. The second thing is they may be able to help. And I've made that mistake where I'm like, this really bad thing that happened, I'm just going to get through it myself and muscle through it so I don't have to freak my investors out. That was a mistake. Yeah. So it's twofold. They know, first of all, they know you're full of it if you're not saying what you're struggling with. And two, they may be able to help.
That's Anthony. I could not have said that better myself. That is 100% correct. And that's why you develop this tight mailing list of people. That's 100% right. Absolutely.
So Heidi, I think to wrap up this part of the conversation, start to cultivate a list, people that are interested in the company. And again, at this point, it's stakeholders, right? Because you don't know anybody that just can be interested that you think is going to be a friend of the company. Anthony, we call this the fundraising phase. Like we just try to raise as many friends as possible. And then in that phase, we're going to be sending out updates on a monthly basis. In that updates, bullet point, short to the point, what's happening, what's going well, and the honest challenges and struggles you're having. And then I think, Heidi, you said it perfectly. You have to have an ask. If you're not using that opportunity to say, I need help, these are the people that you're asking to engage. You want them to be engaged in helping you. Okay, so we've got 2/3 of the way there. What's our third point, Heidi?
So our third is a fundraising plan. And so this will actually, I think numbers actually really help with people who are fundraising. So right now I'm in upstate New York. It is not a capital rich environment. I'd love to have a chance to talk to you about opportunities that we're having for people to create more capital rich environments at the end of this. But it's not a capital rich environment. So if you're raising $1 million, but it's just numbers to me. If you're raising $1 million and your minimum check size is $50,000, you need 20 people to invest in your company. So the question that I have for people is, how many people do you need to talk to get 20 yeses in your company? And in environments that are not super capital rich, I would argue it's probably like 10 times the amount of people that you need, right? So then it's just backwards. So you say, okay, you need to talk to 200 people to get 20 people to say yes. Who are those 200 people? Where are you finding them? Yes, you might be able to get an institutional investor along the way. And I will back up for a second. I'm mostly talking to pre-seed and seed companies. So they may have raised like a friends and family round, but now they're looking to raise like their first substantial round, right? That would help propel the company. And again, just to kind of, typically those are not life science companies. Those are typically, not companies that require this massive amount of capital, right, to get to their next milestone. So the fundraising plan is just that. It's saying like, what's your next milestone? So if you are a company that needs to get a manufacturing site so that you'll do a pilot so that you have your first sales, it's first of all scoping that. Like, how much money do you need to do that? Okay, you need $1 million. How many people do you need to say yes? You need 20 people. Then you need to figure out like, okay, I need to talk to 200 people. Where am I going to find them to get those 20 people? Exactly. And this is, and it's like, and so it's literally just laying that out for founders. And once you tell them the honest truth of that, they actually become pretty successful in doing it, right? Because what they're thinking is like, oh, I'm going to go out and I'm going to get that VC, or I'm going to go out and get this person or whatever. And that may happen, especially if you're doing that cultivation that I talked about with that, investor hygiene, and like making sure that like you've got a good data room so you can send a pitch deck whenever you want. You've got, this good kind of like very tight mailing list of people who believe in your company. But ultimately, fundraising is a sales job. Everybody knows a sales funnel, right? So like, what's your top of the funnel for fundraising? What do you need to fundraise, which is your data room? how can you prep the people who you're going to ask for money, which is your investor hygiene. But then your fundraising plan is just, it's numbers. It's truly numbers. Like, how many people do you need to pitch?
All right.
It's
So I want
shocking how
to
few
I want to
people
add
do
one
that.
thing, Chris. I want to just add one thing. So everything that Heidi said is absolutely correct. And I want founders that are in that situation right now, thinking about raising capital, to ask themselves one question. Should you do all of those things to go raise $1 million? Or should you go and sell stuff and make money? What's going to be less work to capital?
100%. And
for most people, it's selling stuff, not going the funding route.
And that's much less expensive. So I tell people all the time, like, if you can, it really is. If you can, there's nothing like particularly sexy about fundraising. I think we've kind of made it this sexy thing over time, like made the VC thing sexy over time. Yeah, entertainment. I like that. I'm going to take that. But you know what I tell founders all the time, what's the easiest way to get capital into your company? It's to sell something, right? Because then you have a customer base, which you're going to need anyway. There is a reason why only 1% of companies get venture capital. And that, I believe, is probably because only 10% of companies are venture backable based on like the growth that they're needed. And then, 1 out of 10 probably gets the financing.
It's an epidemic in our business and in startups and for founders, is that the story we told, and I was part of it, is that the only thing that mattered was raising capital, and raising capital was success. And it's just, it's so wrong. It's such a wrong way to focus. Anthony, you and I have said it, which is, it's one of the worst days of your life when you take that first check, because you're now on the hook. You're now on the clock. All right, Heidi, I want to ask two just really specific questions, and then I do want to ask about the raising funds. But the rule of thumb is, how much runway, based on my plan, I know you're saying a milestone, but a milestone might be 3 months out. How much runway am I shooting for? I always heard like 8 to 12 months was kind of the ideal runway that you're when you go raise. Is that still true?
So I wouldn't put it in terms of that timing. I would put it in terms of when you can exchange what you're building for money from a customer. So for instance, like, right now I'm working with a company that makes hemp lumber, right? And so, that person needs to like make sheets of plywood made out of hemp, right? So he needs a certain amount of money to get to the point where he can make that for customers who are going to buy it, right? And so the milestone is based on, in my mind, right, like something related to going to the market.
Last question, and this is, I think, a very important one, which is, it's shocking how few founders do the math around actually, hey, I need to talk to 10 investors to get one person interested, and like really go through that. The other piece of the equation is that we're delusional about how long fundraising takes. And I'm talking about the job itself is a full-time job for a founder. So like, hey, we all work really hard. We're talking 40 to 60 hours a week. It's a, what do you suggest, Heidi, 30 to 40 hour a week job if you're doing it right?
Yeah, and I guess what I would say is you probably don't want to only count those hours towards only fundraising, because what you're doing is you're building momentum for your company. Like, anyone you talk to about your company that you're getting on board, even if they don't give you money, I personally think is a worthwhile thing. Because if you talk to 200 people, it might be 1 out of 10 that gives you money, but it's probably a much higher percentage that when they know about your company and they hear something from somebody about the need that your company fulfills, they'll point them to you. So I will say, fundraising, I wouldn't call it a full-time job. That's not what I would say. It takes a significant amount of time and effort, and that's why you have to be systematic about it. Because if like every investor you reach out to, you don't just have a data room that you can send them. And listen, you might have to be a little bit bespoke if it's like a large VC, but like, I don't think that there's any reason. Let's imagine of that 200, 100 of them are high net worth individuals. Let's even say 150 of them are high net worth or not net worth individuals. That's the same data room. Those are the same email updates. And then it's a conversation with them. And I would ask founders, do not book like an hour meeting in person with people. You reserve that for someone who can bring in other investors or things like that, because you'll know very quickly on like a Zoom, or if you're in front of a group of people, if someone is going to invest. And they want you to stop talking if they're not going to invest, and you want to not listen to them if they're not going to invest. So
Right.
mutual.
No is a good answer in this case. I know it's really hard for founders to hear, but it's like, no is a great answer.
Mm-hmm.
Like, I don't know, maybe let me think about it. It's a terrible answer. That's a
Terrible answer.
I want to give you one opportunity before we go into the speed round. Talk a little bit about what you're doing with helping people build funds. It sounded really interesting. I want to hear a little bit about it.
Yeah, absolutely. So I created a Homefield Fund. People can find us at homefieldfund.com. And it's essentially to fill a gap that we've kind of acknowledged on this call, right? So when I was helping to manage some of the SSBCI dollars, and people might be familiar with that if they were raising venture funds in the next 10 years from the federal government, what I found is that people would come to me, and they would be community members essentially, and they'd say, I want to start a venture fund. And I would kind of say, well, what's your path to a $3 million or $30 million raise? And if they didn't have that path, typically the venture fund would not be economically viable, because the cost to set it up from an attorney, we're talking like 75,000 maybe. The costs every year for fund expenses, like maybe 30,000. And so that eats into the amount of money that you're able to invest into companies, which makes the fund much more difficult to return capital to LPs. So people are likely not going to invest in it. So what I created is a GP as a service, essentially. And so Homefield allows people to raise individual funds under us. They are controlled by the person who's raising the fund. But essentially what we're doing is we're making the fund management. So for example, like sending out K1s and all of that stuff, the cost to the customer we make really low, because we're doing it in aggregate. And we also help them fundraise. So I also got a lot of people, accelerators, maybe a podcast, right, who are saying, I want to start a fund to invest in entrepreneurs. And what I see is that they don't really know what that means, right? Like they don't understand like what a liquidity event is. They don't
Is the
understand a
question you ask
waterfall.
them, are you sure?
Yeah, and it's true.
Really?
No, it's true. It's
I think
absolutely
that
true.
if anybody actually
Yep.
listened to our podcast, Anthony, nobody would actually invest in our fund.
There you go.
Really?
Yeah.
Nobody
true.
would invest in entrepreneurs if they listen to
Right.
this podcast.
But it's
Super
essentially that, like, what we do is we have this learning platform for them. So they come in and they're basically engaging, with, it's an AI based platform, and they're engaging with this platform to figure out like, okay, what would my investment thesis be? What would my portfolio construction be? And Chris, I know we're running out of time, but the last thing I want to mention is that the other thing we're doing is we're providing these kind of alternative investment vehicles for people to invest in entrepreneurs, because I think all of us know that, yes, it's like fundraising too sexy right now, like maybe not something people should be doing. But what I also see is that there are a ton of great companies that need $50,000 to get
Right.
to the next round, that might not have a huge exit, right? But the investor can protect themselves by doing things like shared earning agreements and other things like that. And these funds help them set that up. It helps them talk through like, okay, what's my investment vehicle going to be? Am I going to do convertible notes? Am I going to do, these kind of shared earnings agreements or other types of revenue-based financing? Like, what companies are appropriate for those? What companies do I have in my community who would be appropriate for those? And so we do all of that basically as a package. Again, like our customers are accelerators, incubators, economic developers, colleges and universities, and then angel groups that actually want to start a fund.
I think that we need to have you back and have this conversation too, because I'm fascinated. I want to ask about 100 more questions. But before we do, are you ready for the speed round? Heidi, I'm asking you a series of questions. They'll be fast. Just give me the first thing pops in your mind. Profitability before Series A or growth at all costs?
Growth at all costs. If you're raising a Series A.
12 months runway feels safe. 3 months feels survivable. Which builds better founders?
Depends.
That's a good one. Extend runway by cutting team or cutting your own salary to zero first?
Obviously, cutting your own salary.
Founders should check bank balances daily? Or is that just anxiety talking?
Daily. I don't know why they're checking it daily.
Yeah, exactly. I'm in QuickBooks every day. Deep dive resources, simple numbers, straight talk, big profits by Greg Crabtree, The Psychology of Money by Morgan House. But we're going to go to your website. We're going to learn all the things. Home Field Fund, is that right? Did I get that right?
You did.
Cool. And you want to talk to people that are thinking about fund, but also any potential, founders that are kind of starting to think through this stuff.
I'm happy to talk to anybody. I'm a big believer in saying yes to conversations.
You're here, so that's obvious.
That's right.
Yeah, absolutely. That is amazing. Heidi, thank you so much for joining us. Thank you for talking to us about your plow guy and about data rooms. It's been a fascinating conversation. I do want to have you back. I think it's you have a lot of cool stuff that we can talk through. But Anthony, you want to get us out of here so you can get out of here?
Yeah. So thank you. Sorry. Thank you everybody for listening, for tuning in. Please be sure to visit us at howtofounder.com, where you can connect with us on LinkedIn and subscribe to our YouTube, Apple Podcasts, and Spotify channels. Smash that like button, smash that subscribe button. Leave us a great review if you liked Heidi. Leave us a great review. I know you don't like us, but Heidi was great. So leave us that review. You guys are the pioneers of economic prosperity, and we're just grateful to be there along the way with you. Thanks, everybody. Bye.